avoid repetition and move on to additional topic, and we'll be very open to answering clarifying whatever doubts or whatever queries you have. So to begin with, I know many of you from your consensus estimates as well as your own brokerage house estimates, the results which you have declared for this quarter may have fallen below your expectations, particularly seen in the light of the last quarter of previous year and the overall our exit rates on various counts, including our EBITDA per ton. And one repeated query I've been receiving is on realization, why our realization drop has been probably higher than expected, or some peer group companies you have been comparing with. Though if you really look at, also some of your colleagues have shared with me comparative companies who operate in similar geographies. In that, if you were to compare, but I don't see the variance being very high. But be that as it may, I would like to state what is our position on the matter. First of all, when you look at realization, you shouldn't look at it in an absolute term, because the previous period and current period are not always comparable. If you were to look at the regional mix, the market-wise mix. And in our case, the market-wise mix has changed considerably. It's a weighted average of the various regions. And so in our case, the market weighted average of the market-wise composition has changed considerably due to addition of Mukutban, where we have had not only the maximum capacity utilization but also ramp up. So much of the volume growth which you have seen for us has come from Mukutban, and that will change our overall mix in the realization. But that's one aspect. I'll dwell on that later on, because I would like to discuss with you our views of how the realization of the markets have moved in each of our addressable markets, our relevant markets. But overall, what I'd like to add, everybody has spoken of, and what is there, all of you in your commentaries have spoken about two factors which affected Q1 of this year. One was the elections, and secondly, the extended heat wave, which resulted in, non-availability of workers. A lot of workers also went home for the voting, and the rest of it, which affected the market. But a third element, which for some reason everybody has not spoken of, is the pricing behavior of the leaders. Despite the volumes, whatever volumes you have seen, especially the volumes you have seen in June, we don't think that kind of a softening of prices or aggression in pricing was really warranted or called for. And that was something I don't think many of us factored in. And that there are reasons for it, which we can only conjecture. One is because of consolidation in the market, people were, wary about losing market share. So there was a defensive pricing strategy. Nobody wanted to yield market share to their other larger competitors. So they tried to hold on, and therefore they were less, bullish on pricing. And not only less bullish on pricing, the price situation diluted, and I'll dwell on that also a little bit more. But more importantly, due to lower capacity utilization in the units, many new units have come up, and all those units which have come up, the newer units are all incentivized because they're the grinding units, they have incentives in the key markets. And so there was a double benefit with many enjoyed. One was the lower input cost, and on top of that, the benefit of the incentive which came. And so the more they ramped up the grinding units, etc., they had a bigger cushion. These two things probably facilitated a soft pricing strategy, especially by the leaders and some of the bigger new entrants. And this was particularly relevant for some of our core market areas, which primarily I would say, first of all, which is of great importance to us, is Central India, which is UP and Madhya Pradesh. UP had another factor. UP, if you see in every way, whether it's in terms of volume growth or whether in terms of pricing, all of you have the statistics, if you see the pricing pattern of UP for almost 2 years, till I would say the third quarter of the previous fiscal, UP pricing held on, and in fact there was marginal increase from time to time, but certainly there was no slide down. But UP, the scenario changed during and post-elections, and UP, therefore, you will see a lot of dilution of prices in the UP region and consequently also parts of Madhya Pradesh. And this is a phenomena which I said affected people like us because we operate in this area with practically at 100% capacity utilization. So our strategy here was we certainly didn't want to dilute our price positioning. We tried to hold on to our price positioning, and in our price positioning, something we have worked and built upon over the years is our entire premium brand positioning, which is there. So we were very clear that we don't want to lose either market share or dilute our price positioning. To our surprise, we saw some market leaders who were at one point in time enjoying almost 20 or 30 rupee premium, even within the A category other players. Today their pricing levels have come down they've actually wiped out their entire premium and they're operating at a much lower premium. And secondly, another very interesting or new phenomena which we saw, though there were a lot of talks a year back about people withdrawing all price equalization discount or RDs from the thing. If you go back to these markets, some of you who do channel checks, you will find that the PE and the RD levels have actually not only shot up, but it has shot up very, very exponentially. By our estimate, in some places, markets operate in our relevant geographies to 30 to 40 rupees P, which has resulted in the WSP position, that's the wholesale price position, significantly coming down, whereas retail doesn't fall in the same way. So the margin between WSP and retail has gone up. And that has caused certain aberrations in the market, because also the dealers, their investment gets stuck in the market, because what they pay for and then subsequently what they receive back in P and RD, which is after a lag, requires greater investment. So these have caused certain distortions in the market. So this is just in terms of background. So what's relevant is what has been our strategy. Our strategy, as we mentioned to you, was first of all, we are very clear that we do not want to dilute our price and our brand positioning. We as a company have believed always that investment in cement, contrary to popular belief or counterintuitively, it doesn't mean investment only in plant and machinery or setting up new units. Investment also what you make investment in the go-to-market assets, which includes logistics, your entire distribution network, channel, therefore, and then finally, obviously, your brand pull. For us, that is equally important. And we have invested in this consciously in the last 7-8 years, which you are aware, from being primarily a Birla corporation, which used to operate at a B- or a lower thing. Today, we operate with more than 55% of our trade volumes in the premium category. And I can say with some degree of pride, as I told you, if you today go into the retail segment, in these markets, some of our key markets, you will find us to be at par or in some cases maybe a slightly higher than some of the market leaders. So we think this strategy has paid off for us. Equally, if I were to look at, if you see Mukutban, where we have been an entrant in just about a year back, even today we are selling more than 40% of our volumes in the premium category despite being a new entrant. And our ramping up there has been also, some of you would see in terms of the percentages, what we have ramped up It has been much higher, and that too within the premium category in the trade channel. And even during this period, we have succeeded in further ramping up Mukut Band. That's why we have a 91% weighted average capacity utilization, and also maintain prices there. So we will continue as a strategy. We have done it now. We'll continue to maintain our brand strategy, invest in the market, because we do believe that this market situation is temporary. It is not going to last forever. There will be sanity prevailing and market correction, and at that point in time, we don't want to be relegated to a lower pricing point, and we will therefore continue to do that. Secondly, what we have done is geomix optimization. When we talk of geomix, we don't talk of it in the larger context. We talk about within our core markets. So our core market, for example, is Eastern UP. So we would like to focus there, defend our market, and grow there. That's why our investment is now coming up in Kundanganj, which is going to start operation early next fiscal. And then also we will also get the advantage of the incentives in the new plant, which is now the old Kundanganj plant have the incentive has dried out, has stopped, but we will get it, and that will increase our competitiveness. And again, therefore, when we get back there, we do not want to dilute our, the price positioning. So our focus and strategy, that will remain. Secondly, what we have tried to do, we tried to also expand our footprint position in the secondary markets, which are there for us. So Mukut Band, we have tried to increase our footprint. As we increase our footprint from Mukut Band, since our plant is located in Vidarbha, we will see some amount of dilution also in realization the further we go. And it's the same thing with Bihar is a market which has been growing on volume. There also we have been consciously working on our brand strategy to upgrade our volumes, get a more quality volumes over there, more premium volumes. That will also affect. And Bihar again is a market where prices, as you know, in Eastern India were very, very depressed, and there we have lost on realization. So I'm giving you this, granular detail of region, so that will give you a picture. But where we have, honestly, where we've been hurt most is in Rajasthan. Rajasthan, we've been hurt because, the price levels crashed. People have been discounting heavily, but there was a salvation for everybody in Gujarat. Until the previous quarter, Gujarat was doing extremely well. Gujarat pricing was higher. So a lot of people, a lot of other companies also, you'll see a lot of their profitability was coming from Gujarat. But in the last quarter, Gujarat tanked. And Gujarat having tanked, for a company like ours, which has got a high cost of production, that's no secret, everybody knows, we have been rendered uncompetitive in many places, including there's been a huge shift because of capacity utilization. People have shifted to non-trade, that's institutional sales, and OPC. And we found ourselves to be quite outpriced in many cases. In some cases, we had to actually choose not to compete. And it's been crazy out there. Plants, our customers within 50 kilometers of our plant, we found our prices were undercut. So we have lost a chunk of our premium, our volumes and our realization in our Chanderia plant. Chanderia plant again is where we do not have a very high component of premium products, and we have got just about 25% of our product sales at the premium. And while we have held on to that volume or improved that volume marginally, certainly our base product, popular product, Chetak, has been quite hurt. And as I mentioned again, our realizations, though that has a higher component of OPC and institutional, we have lost there as well. So it's a combination of all these factors which has, if you see brought down, it is not that any places where there is a dilution which has overall reduced our realization. We are conscious of this situation, what has happened, but we have decided consciously also to ride this through, because we genuinely believe, as I repeated earlier, as situations stabilize, as equilibrium sets in, there is greater sanity. Markets have to improve when the demand improves, pricing will improve, and at that point in time, we want to be in a position of strength because a reality for us, we know that we are not going to add very major capacity going forward in the next 2 years till 27 when our plan is to go to 25 million tons. So during this period, our objective is that we will play at the position where we have chosen, not dilute, not get relegated back to A minus or B category player. We want to continue in our listing in whatever we sell. Our company's vision is that we may not be the biggest, but we want to be the best in class. That is something which we say, and that is what we want to practice. So hopefully this has given you some broad overview on the marketing and the pricing front, and we will take on the other elements. Subsequently, my colleagues will talk. Only two other things we like to continue to add is, like everybody else, our investments in terms of cost reduction has happened. Some of you have even commented in your commentary that about the reduction in operating costs which we have reported. I recall reading somebody said that that's the only silver lining they have seen in the results, but it's not a surprise. We have been doing this. We've been doing excellent work on Project Shikhar. We've been doing great work on Project Unnati, which is related. A lot of it is related to logistics improvement. While those are happening, and so as renewable energy thrust, our own captive coal mines on which we will deal on in the progress of it in a bit. We will talk about that as well. So while those will do, but there are many more strategic other things in the anvil and pipeline which we will talk about it in due course. Some of them are we cannot talk about it now, which will happen, and so our thrust on cost will remain. Equally, we will try to tactically increase, as I said, our geographic footprint. So we have plans which was discussed many quarters ago, and you may not have, some of you may not recall, we had plans in setting up a grinding unit in Bihar, in Gaya, which for a variety of reasons was earlier put on a, shall we say, on a slightly slow track, but now it's back on fast track. Our situation is improved. The new government is very, very receptive to investment. They've become proactive. So we are almost completing our land acquisition there. There are a couple of other also grinding units or extension we have in plan on which we should be in a position to talk to you by the next quarterly call. So those things will go on. So that is business as usual. There is no let up in focus. That will happen. So this is the mix of strategy on which we are going. At the moment, we are not really doing any crystal ball gazing beyond what is there in public domain from all of you in terms of how the market will behave going forward. Everybody is projecting that, okay, if GDP growth is 7%, the year we are supposed to end cement also in 6 or 7%. How that will pan out, things can go in various directions. Post a good monsoon with a lag, there can be a great demand surge. But to get to 6 to 7%, one will need a hockey stick effect in the second half. So we will hold our horses till for talking about those things till there is greater visibility in the current scenario, economic, political, as well as industry scenario. So we are not really sticking our neck out to say too much about it. So with that, I will open the slide. Yes. With that, I'm opening the call for questions. And as I said, we'll try our best to answer your queries. Let's not repeat things which we have already addressed. Anything more, please feel free to come across. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you, sir. Sir, two questions. So, one is on the volume front. So, last time we said 8 to 10% growth that we are looking at in FY25. So, already 0.7% decline this quarter. So, given if you also can share what was the Mukundban volume in this quarter and for full year, how much we are looking at. So, what's the revised guidance on the volume growth front? And second, on the profitability, last time we had talked about 8 to 10% growth on EBITDA per ton. So, that close to 880 odd rupees per ton. But given the 603 EBITDA per ton, the ask rate is now significantly higher, 950, 970. And given the pricing pressure is already there, and we are saying, so even second quarter, if it is also muted, then for second half, we need a significant close to 1,200 rupees kind of EBITDA per ton if we want to have 880 rupees. So what's the revised guidance on volume and EBITDA per ton?
As I mentioned, we are not giving any guidance just now because the market is very, very nebulous, the situation. So I think it would be imprudent for us, not just from our side, but even from a market standpoint, to stick out and mention any numbers. So we would go by what all of you are predicting in terms of the market growth. As I just said, that people are talking about a 6 to 7% volume growth. If the market grows that way, we have that much of cushion and headroom because especially of our Mukundban, upside, as well as we've got upside in Chanderia. And then even in our existing units, we've got upside. So we don't see a problem if the market picks up to be at par or slightly ahead of the market over there. In terms of profitability, again, we would not comment just now. We, of course, have our ambitions, what we have stated. We will still try to do that, but we will not either revise or give a firm guidance at this juncture. Mukundban question you asked, we have done 5.93 KT in Mukundban in the last quarter, which given the market conditions and the usual dip one sees, we are personally very happy and with that number, and especially since the number has come a large amount of it from premium, and a lot of it has come from the core area of our proximate area of the plant. And that gives us, and we have been in our strategy, we have been focusing more on blended cement. Even that has been kept, though we are open to revising some of the product mix if the market so demands. But so far we have been on track and strategies. We'll leave it at that. Next question, please.
Mr. Shah, does that answer your question?
Sir, the last one is just wanted a lead distance for this quarter, 1Q, and what was the capex in Q1 and for full year, how much we are looking at?
So the lead distance was around 350 kilometers. We are maintaining our guidance for capex for this year. It may be slightly less, but we are maintaining our guidance on that.
Okay. Thank you and all the best, sir.
Again, on lead, I'd like to clarify. We are not making it granular to compare our lead with our older markets and newer markets. Obviously, because of Mukundban, where we are trying to increase our reach and footprint, there will be some increase of lead there, which might compensate for the reductions which we are achieving in other areas for our geomix optimization. So we are doing a lot of optimization elsewhere so that our overall lead doesn't change, but there is a certain, we could have probably dropped it further if we just looked at our existing units, but Mukundban is going to add some more lead distance to our overall weighted average lead.
Last, if you can squeeze in terms of the from 20 to 25, 1.4 Kundanganj, 1.4 Prayagraj, and how much we are planning to add at Gaya, and if the timeline possible when that all these plants will come up.
So we have whatever we have said about the expansion that is contained in our declaration. We are not going to make any more specific comments on actual things, because that will be contrary to our disclosures. Thank you. We should move away. Not any more supplementary on that, please. The next person, Jyoti Gupta, please go ahead.
Thank you. The next question is from the line of Jyoti Gupta from Nirmal Bang. Please go ahead.
Thank you so much, sir, for the opportunity. My question is, while you're saying that the trade mix has actually improved by 59% of the total sales, so one is, what is the breakup of trade, non-trade? Second is, if it has increased, then how has it impacted? Why has it actually impacted, or why has it not stabilized the realization? Third is, could you provide us numbers on the regional mix in terms of north, south, and what has been the shift in terms of the regional mix?
See, first of all, as I said, our trade channel, we have tried to maintain. Trade has not increased in this quarter.
Premium.
We have talked about premium being 59. Trade, we have kept it same as previous quarters, because in fact there is a just 1% decline, you might say, marginally, and that's because how the market has behaved. As we said, that a lot of people, because of lower capacity utilization, they have been focusing more on OPC, etc. So, and the general market. So trade has not, we have not increased trade in terms of percentage. Premium we have increased from 55 to 59%. But again, you'll see, Jyoti, you have to keep in mind that weighted average thing. So while I'm selling more premium, say in Maharashtra now, as a total component, my Maharashtra premium prices are obviously lower than what I get in UP. So you are not going to get in the weighted average that sort of an impact. So you have to look at the entire in totality. So therefore, what I say is, when you're comparing realization for us year on year or even quarter on quarter, our thing is not like to like, because it is not in the same markets where we are expanding.
Okay. Okay. My next question is, I understand that a lot of companies which have put up new plants are actually running it by the new lines, and therefore, there's been a significant improvement that they're able to show in their EBITDA pattern. But I thought we will see some incentive gains or some improvement, something coming from Mukutban, because for me, this decline in EBITDA pattern is pretty significant. I'm not able to understand why such a steep decline, even if I take even considering the way Birla Corp is actually operating the last 3-4 quarters.
I try to explain that, Jyoti, in fair amount of detail, because
I got it.
Again, repeating, it's a weighted average of things. All regions have not moved. I told you about UP.
Regional mix will help. Can you share regional mix numbers? Is it possible to do that?
We have not. I'll come to that. But first of all, let me answer your first question.
Okay.
Mukutban incentive. Yes, Mukutban incentive we have booked. We have booked Mukutban incentive this time, and it is in line with whatever guidance we have given. But at the same time, Kundanganj incentive has gone out of the system. So that it doesn't fully compensate for what Kundanganj was. Kundanganj, you will understand, is a plant which produced over 2 million tons. And just about the same thing is coming about in Mukutban. We are at around the same level, but at a lower price level, at a lower, therefore, GST level. So obviously the incentive levels will not be the same. And in terms of regional sales, we have given you broad indications. I think giving specific ones will be correct on our part, because we have not declared that in the results. We don't give, but you know broadly how we operate. unlike I was seeing some other companies just now, they have given the statewide percentages. We don't declare it in that manner either annually or here, so I wouldn't get into those specifics. But people have a broad idea because of our plants, our location of the plants, etc. What is our broad pattern across regions. And I've also given away to you what is my Mukutban volume, so obviously you can do very simple back of the envelope calculation to get them.
Okay. Thank you, sir.
Thank you. The next question is from the line of Mangesh Barang from Centrum Broking. Please go ahead.
Hi, good afternoon, sir, and thank you for the opportunity. Sir, a couple of questions. So, thank you very much for giving a detailed explanation on realization in your opening remarks. So, my question is on the industry pricing. And as you said that industry leaders are actually keeping the pricing lower in the markets. Where do you see the revival coming? Is it only because demand has been weak now and after demand recovers it will come back? Or do you think that it can sustain, that weakness can sustain for a longer time? That's the first question.
See, I can't read other people's mind, and they are the leaders are far too big people for somebody of our size to try and read and predict their mind. So, as I said, we were wrong in terms of I have no qualms in admitting what we expected, the kind of behavior in the first quarter. I repeat that we don't think the volumes, the kind of volume change or drop, and if you see the kind of volumes, especially people have done in the month of June, warranted this kind of price correction. So difficult for me to predict how the competitive scenario will pan out, because as you see, every second day there is some new announcement happening in the industry. So you all who are much more informed about companies would probably be in a better. We are price takers. We'll have to plan our strategy as per how the market goes. We are smaller players. We have no illusions about that. And so we'll have to protect our turf, protect our thing, and we will do what we can. We are not going into acquisitions, as I said. So therefore, our investment has been, a lot of investment has been in brands. So that is where our assets lie. Not just brand, it's the whole entire go-to-market assets, which distribution assets, which is our people on the ground, the feet on the street, which we have got, the investments we have made in software for customer relations and logistics. We are continuing to make things. We are in our ILMS system. All of that we are doing, and we can't just fritter it away getting into a pricing game with the big brothers.
Okay. So secondly was on CapEx. So I've maintained our CapEx of I think 800 crores for this year. So I just wanted to understand, the timelines for the 2 units that we are planning, when they would be operational. So when actually should we take the additional capacity in our number?
We have mentioned Kundanganj. Bihar, I said that is in the pipeline, but we are not giving any firm dates or anything for it because we have to make a formal announcement on that. And overall, we have said that 25 million ton by 2027. We stand by that.
Understood. I'll come back in Q1. Thank you.
Thank you. The next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Yeah, namaskar sir, and thank you for the opportunity.
I missed you at the AGM. Normally you are one. So yes, sir. I thought the question in the AGM, instead you have come in on a virtual call. You are closest to our office and still you come through a telephone line.
Yes, sir.
Using your queue. Anyway, go ahead.
Thank you, sir, for enlightening me. Sir, firstly, Saraogi sir, can you give me the current maturities for the year? And about the NCD issuance, what are the rationales for going ahead, and what kind of cost of fund are we looking to price the issue?
See, NCD is just an enabling resolution. In case the terms are more competitive, then only we will go for the NCD. I mean, we are flexible whether it is the NCD. And today we are not under any kind of obligations or in the point of SEBI regulations also. It is just an enabling.
Sorry to interrupt, sir. Ladies and gentlemen, the management line has been disconnected. Please hold. We shall reconnect them shortly. Ladies and gentlemen, the management line has been reconnected. Over to you, sir.
So, as I was mentioning, so it is just an enabling resolution, and if we find the terms of NCD more competitive, then only we will go for it. Our average cost of borrowing currently is 7.9%, and any fresh borrowing that we understand is also expected to be south of 8%. And in terms of the current maturity in this year, it is 375 crores, including 135 crores of NCD.
And sir, what are the receivable dues from the government incentives?
Other than West Bengal, it is about 500 crores.
Okay, and last year, how much we have received?
In this last year.
Last full year. I mean, I just wanted to understand what are the receivable general inflow from the incentives that we.
Guys, you can't project that as a trend because last year we did not get any amount from UP government, where most of our incentive is receivable from UP government, whereas this year we are expecting a large amount to be received from UP government.
Okay.
It doesn't happen in a pro rata basis. The way Shakib, you know how governments work.
There were some procedural issues which have got resolved. So bulk of the amount we expect to receive from the
government's budget, everything else. So that's not in our hands. We can't really predict that.
Okay. As of now, you mentioned 500 crore as the closing receivable balance.
Yeah, right. Other than West Bengal.
Other than West Bengal. So that is from the state of UP only, the 500 crore.
See, mostly. Small part of maybe 40 odd crores from MP.
And then we'll have Maharashtra also adding up now. 21.
Okay.
Yeah, it is not clear.
Not factored.
Right. Sandeep sir, exit of June also we have been witnessing the correction in cement prices, or the realizations are down. So can you give some more color? 5 to 6% further correction we have seen, as you were alluding that these prices are not commensurate for the market, but even exit of June, can you give some color on the same?
Oh, you're saying the change from exit of June to now is what you're saying?
Yeah.
No, I don't think it's a 5 to 6%. It is not a 5 to 6% change. Then the market everybody will, half of us will close down.
Oh, sorry, sir. But can you give some color, sir, how the market is behaving since this is a monsoon quarter?
Market has weakened. Market has definitely weakened. It's different in different regions, but there is no change in behavior we have seen for people in everywhere. So it's a variation between some areas is 3%, 4%, or that's the kind of.
Okay. And two small points. Firstly, on the coal addition, that will be self-mining activity. How are those going to improve?
Just to clarify and recall, as I said, it's a range. So we would, if you see our impact, we look at it between 1.5 to 2%. We don't, as I told you, some areas it could be more where there is a slide, and then you see the composite between trade and non-trade and all of that. but it's not 5% across the board. I would like to reiterate that.
Right, sir. Sir, I was seeking some additional information about the availability of further coal that which will be mining. What is the status of the additional coal volume, and when will that kick in? And other efficiency steps also which are in the annual that will further lower our variable cost. And last point is on the Supreme Court ruling on allowing states to impose further imposing them more power on for further cess also on the minerals from the land. So does limestone also falls under that? So what's the thought process of the management on the same, sir? These are my two questions.
Last one, I would react that we can't be, again, conjecturing what the government is. In each government, there are several governments with different kind of stakes in minerals. So how they are going to do. And that will be an industry-wide effect. So we don't see that, being specific to us over there. So that is not something which is, we would like to comment just now. And on the coal...
Yeah, coal, as indicated earlier, we expect Bikram coal block to be operational by the end of this year. So we'll see the production really will come from the next year. And the other one, Machiwata, we had indicated that we expect it to commence in FY25. So that is what we are expecting right now. And apart from that, as Mr. Ghosh indicated in his initial opening remarks, across the board, whether it is manufacturing, whether it is sales, marketing, logistics, across the board, there are multiple programs which are being undertaken for cost rationalization. So basically, there is no particular area or no particular scheme. There are multiple numerous schemes on which work is going on.
Two major initiatives we've always indicated is Project Shikhar and Project Unnati. Unnati is to do with the go-to-market side. Project Shikhar is the supply chain and actually manufacturing plant costs and overheads.
So cost reduction you will see on a continuous basis. You will find cost improvement.
And also renewable energy, etc., which is will go on. AFR, renewable energy, all that is part of them. Some of them are part of our capex, and the rest of it that continue. And as I said, we are absolutely focused. While we don't see a huge difference between us and somebody else doing, but we are not going to lag behind others either.
Right. Sir, thank you for all the answers, and also do provide us some comment on the jute division. You did not allude to the fact that jute being a small part also, but this time I think so there were some extraordinary factors that resulted into poor numbers. So if you could just enlighten us on what happened.
Mentioned that, Saket, in a fair amount of detail in the press release.
Yes, sir.
But you live in Calcutta, and you know the jute industry is in doldrums. There are statements in vain, including by Mr. Irfan Pathan, who has given a statement. So right now, jute is in totally topsy-turvy thing. Good for us is that we are not totally dependent on government order. We have a large chunk of our private orders, as well as we have an export business. That's why, while many units have shut down just now, there are big plants which have declared shutdown for 45 days, 2 months, and the rest of it. We are running, though albeit with a slightly lower number of shifts, but our plant is operational. That is going on. And we are committed to this business. We are not here in an opportunistic way. As you know, Birla Corporation started with jute. This is the first enterprise, so that's why we are a 104-year-old company. Here, that was our first unit, so there is both sentimental, emotional, and management attachment to it. We will persist, and if there are these kind of 5 crore loss in jute, those things we will have to take in our stride, because it's really speaking, it's like the mother of our company.
Thank you, sir. I joined the queue, sir, and all the best to the team in these tough times.
Yeah. Thank you very much.
Thank you. The next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Hi, sir. Good afternoon. My question pertains to first on could you share the fuel cost both in Q1 and what is the current consumption cost you're looking at in Q2?
So in Q1, the fuel cost was rupees 1.48 per million kilocalories. Right. And going forward, we expect maybe about 5 paisa of further reduction as of now.
Okay. And sir, incentives you mentioned you have booked in Q1. What was the amount in Q1 and same number in Q4 on total basis?
Q1 it was 21 crores and we are maintaining our guidance that we had provided earlier for the whole of the year.
And Q4 it was how much, sir?
Q4 it was around 44 crores.
That is because Q4 we also had Kundan.
Yeah.
So you can say right now between quarter and quarter it is less than half.
Mm-hmm. Okay. And so this coal, how is this, the percentage I think last year was close to 18% of the total coal requirement was captive. How will this number be in basis your current ramp-up plans in FY25 and FY26?
That we can't share just now. Maybe in the next call we can share about this.
Okay. And lastly, on the progress on the Prayagraj and Kundanganj expansions.
Kundanganj we mentioned that we are looking at early next year. By second quarter next year, we hope to start Kundanganj. Prayagraj, we have not started work as yet. It's in a state of we're getting it ready, so it will follow after Kundanganj, and we'll give you an indication later.
So Kundanganj all equipment ordering would have been already done?
Yeah. Kundanganj, a lot of work has already happened. A lot of work had happened even earlier.
Mm-hmm.
Kundanganj, we're moving on a fast clip.
And this Mayer clinker, any thought by when that plant you're looking at, clinker expansion at Mayer?
We told overall, Rajesh, we will not speak exactly where, but we are committed to our 25 million tons by 27.
Okay. Great, sir. I'll come back to you. Thank you.
Thank you so much, Rajesh.
Thank you. The next question is from the line of Raj Mahadevia from Manigro. Please go ahead.
Hi, sir. Thank you for the comprehensive introduction in the beginning. Just a quick question. What are the plans, either organic growth-wise or unconventional out-of-the-box steps for deleveraging the balance sheet? Because your interest coverage ratios are pretty weak, given the leverage.
I think our leverage is not high. In fact, as of 31st March, our debt to EBITDA was less than 2. So on what basis do you say we are highly leveraged? In terms of debt to EBITDA, it is comfortable. In fact, our rating also based on our last year's performance, the outlook which was turned to negative, those have also been reverted back to stable by the rating agency.
Yeah, so from a servicing perspective, I guess you're okay, but your interest coverage ratio, if I look at it this quarter, is not very strong.
You can't look at quarter to quarter first. You have to look at it from a more long-term perspective.
Understood, but even if I look at FY24, an entire financial year, your PBT was 573 crores, whereas the interest finance cost was 371 crores. So that's a lot of leakage.
See, we have always maintained that we track our debt in terms of debt to EBITDA, and as long as it is 3, we are okay. As of 31st March, it was less than 2. And this is what we have always maintained across all forums with the rating agencies, with the bankers, and with the media, with the investors, everyone. And we continue to maintain that. We continue to track our leverage in terms of debt to EBITDA. And which we will continue to do so. As long as debt to EBITDA is comfortable, because EBITDA is an indication of profitability, as long as debt to EBITDA is within the specified range, we are okay with, we will definitely be okay in terms of interest coverage and other ratios also.
Understood. And given that your plans that presumably now you will go slower on capex as mentioned, will the priority be to pay down debt on the balance sheet over the next year?
No. We are not going slow on CapEx. We are maintaining our guidance of reaching 25 million tons by 27. So there is going to be CapEx, but at the same time, we are not digressing from our philosophy of maintaining debt within the range of 3 in terms of debt to EBITDA.
All right. Thank you.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you, sir. Sir, last time you said that we are...
Shravan, you're playing a second innings now. This is a ODI. You don't play a second innings anyway.
Sir, if I allowed, the first guy has actually played the test, Mr. Kapoor. He asked so many questions. So in that sense, I thought I can also play test.
Okay. Chalo.
Yeah. Last time we said that net debt for this year by FY20 and we are looking at net debt would be lower than 3,000 odd crore. So there we are maintaining that stand, or there also we are having...
We are maintaining that.
Okay. And sir, we mentioned about the cost reduction. So if you can help us in terms of any quantum that we are looking at now onwards, by end of this year, how much more, or even by FY26, how much more cost reduction can happen?
This is Rajat here. Good afternoon. The way our MD has already briefed about the project, this is a manufacturing transformation project, which we are working in all the areas of operations, including the efficiency. And if I see 3-4 areas which are the key areas, one is the renewal. The increase in the renewal percentage, even in last quarter, it was 27%, and gradually it will improve. And second one is the AFR. Of course, the AFR is again a delta between the fuel cost and this. So this will also we are working on to improve further on the AFR. And third one is the efficiency improvement, both electrical and thermal in our all plants. So all together you can see that this year we have taken a stretch target of 40 rupees reduction, and similar will be there for the next year also.
Sorry, you said 30-40 rupees, sir.
Yeah, we'll close it here. And thank you very much for participating. I will only close with quoting something we have written in the press release. The company has invested a lot in the last 8 years in building our organizational capacity. Today, our depth of management, leadership, as I said, our assets in every front, not just in manufacturing or marketing, but how we are managing our HR, how we are managing, our other capabilities and competencies that have increased, and therefore, we say with a lot of conviction that we will stay the course of our strategy. We don't want to move knee-jerk. We are not, we'll not do flip-flops. And that's why what you have seen, we have not hesitated in putting up front the actual thing without any way to, dress it up or say, beat around the bush, because we are confident of our strategy. It can be temporary blips one can go through, but the way we have tried to work on things for the last so many years, and in the last 1.5 years in particular, we stay committed to that, and that's the confidence with which I would like to leave all of you. You'll see if there is something requires a course correction, we will come back to you and state it up front. Otherwise, you will see a consistency in approach of Birla Corporation, the kind of consistency you have seen, and also along with that, 2 more important things you will see from us. One is total transparency. Secondly, highest standard of governance. Because our thing is to be not only as I said, best in class, but also the most respected in our category. So we will work towards that. and that is something which you can take from me as long as I'm at the helm and the current leadership and our chairman. You can expect us to be exemplars in that way. Thank you very much. Pleasure.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to Mr. Rajesh Kumar for closing comments.
Yeah, thanks everyone for joining this call on HDFC Securities. Thank you all again, and with this we conclude the call. Please, Bill, you can conclude the call.
Thank you. On behalf of HDFC Securities, that concludes this conference. Thank you for joining us. You may now disconnect your line.